So let me just begin. My slide's not moving on. There we go. Right. So throughout my session, I really just want to cover a very basic business structure that we see quite a lot of, certainly long-standing businesses end up looking like. So when a company incorporates, you normally have a trade that you want to run. You might have a single shareholder, it might be a family business, so there might be a few members of the family or a business partner. But you've got the shareholders owning a single company, and they commence a trade. Over the years, hopefully the trade is successful, and by the time it comes to sort of 10, 15 years down the line, the company's made a good amount of profits. It's perhaps now built up quite a significant cash reserves, or even the company has used some of those cash reserves to either invest in buying its trading property, or and in a lot of cases that we see, we actually have trading companies but owning rental properties, whether that's residential or commercial, or you've invested in stocks and shares, or you've done something to make that cash work for you when you're not actually using it and you're not needing it to extract personally. So obviously it's great that the company has been successful. It's created these extra assets that it doesn't necessarily need for the trade, but this actually has some downsides from a tax perspective. The first thing is trading companies often benefit from certain reliefs, whether that's capital gains tax. The most obvious one is entrepreneurs relief, or what's now called business asset disposal relief. So as long as you're selling shares of a trading company, you'll pay 10% tax on the first £1 million. The problem is if you've now got sort of a significant residential portfolio of properties, you may no longer have a trading company, and therefore you may not qualify for that beneficial 10% capital gains tax rate. Also, for inheritance tax, business property relief is a very important relief for business owners, provided it's a trading company. In most cases, the shares should qualify from 100% relief for inheritance tax. So obviously, trading companies become very valuable over time, and especially if they've been handed down through generations. So it's very important to a lot of business owners, especially looking at business owners who are in their later years, looking towards retirement. If they're going to hand some of the shares down to future generations, they'll want to know that there's still business property relief available. And again, having non-trading assets in the company, and especially property investments, could cause an issue for business property relief as well, for inheritance tax. So most of my day-to-day work is looking at these types of structures and making sure they're as tax efficient for the owners as possible. And specifically what I wanted to focus on today is how, if someone came along and let's say something went wrong with the trade, and there was a significant claim and the trading company had to pay out, then potentially their cash and property portfolio might need to be used, and the portfolio realized to pay out any issues that have arisen. Or it might simply be that the trading company can't meet its debts and therefore has to use these valuable assets to cover that. So the question is, how do we make sure that these assets that have been built up over time cannot be used by suppliers in any kind of way in that shape? So what we normally look at in this kind of structure, when the sole aim is to protect those assets, is inserting a new holding company. There are other methods which could, and I will come on briefly to demergers, but they're a lot more complex and a lot more expensive to implement. So as I say, if the protection of those assets is the main aim here, then hopefully a more simple share exchange option will be suitable. So the way we do a share for share exchange is we have an existing trading company. I've already talked about that structure, and we'll incorporate a new holding company. At this point, this company is just a brand new company. The existing shareholders incorporate that maybe with 1 share each. And then we do what's called a share for share exchange. Basically, the holding company buys the trading company shares, and instead of using cash as you would expect on a normal sort of third party takeover, the holding company issues new shares in itself. So hence the term share for share exchange. All we're doing is swapping trading company shares for holding company shares. To talk about the tax implications briefly, there's a number of things we have to consider as tax advisors to make sure there's no upfront cost from a tax perspective of implementing this structure. The first is stamp duty. And it's important. I'm talking about stamp duty, not stamp duty land tax here. So stamp duty is 0.5% on the value of the company, and because the two companies we're talking about will be connected, it's the stamp duty potentially is chargeable at the market value of the company. So if we've got a £10 million company and we don't qualify for relief, potentially 0.5% of £10 million will become payable as soon as we do this transaction. So one of my first jobs is making sure that relief is available. And to put it simply, as long as we do everything in an identical fashion, i.e. the shareholders before are the same shareholders in TradeCo are the same in HoldCo, they hold exactly the same proportions, and what term is used most commonly when we're talking about these is that there's a mirror image. So everything is identical before and after. And therefore, HMRC should grant relief from stamp duty. They'll still stamp the document to say the shares have been transferred, but they will provide relief so that no stamp duty is payable. The next important tax here is capital gains tax, and there are specific share exchange provisions in the legislation. Again, it's quite similar to stamp duty. As long as we meet those conditions, then we will qualify for relief from capital gains tax. And the way those conditions work is that the legislation says if you qualify for this relief, those new shares that you now own in HoldCo will be treated as the exact same shares you held in TradeCo. Even though obviously we're talking about different shares, the legislation treats them as the same thing. So we often use the term they stand in the shoes of the old shares. What that means is that, again, coming back to things like business asset disposal relief. So if you're going to obtain the 10% tax rate, if we insert a HoldCo and we don't qualify for the capital gains tax relief now, but let's say in 12 months' time someone comes to buy the company, you won't have held shares in HoldCo for 2 years and therefore wouldn't qualify for the 10% tax rate when someone comes to buy the company. What the share exchange provisions say is that they are the same asset as the original shares, and therefore technically, even though they're now shares in HoldCo, they're actually you have held them for 2 years. Let's say you've owned TradeCo for 10 years. Your holding period of 10 years carries over for capital gains tax purposes. So you now hold, for the purposes of business asset disposal relief and those kinds of reliefs, then you'll hold the shares for at least 10 years. So that's a very important relief that we need to make sure we're happy that the conditions are met when we implement this structure. And the other important thing to say there is that HMRC will provide us with a clearance before we do this. The clearance is, we would always go for a clearance on these types of transactions. Obviously, it provides some certainty to the shareholders, but also in the event of a future sale, on due diligence, it's very common that we would get the question, can we see the clearance and can we see HMRC's approval, so that we know that the transaction was enacted in the way that HMRC agreed to. The only thing to note on those clearances is that HMRC, one of the conditions for this relief is that we're not doing it for tax avoidance purposes. Obviously, if we're inserting a holding company so that we can protect some of the assets of the company, that's a wholly commercial purpose. So what the clearance says is HMRC are happy what we're doing is not for tax avoidance, and therefore they will accept that the conditions are met. But it doesn't say that the specific conditions that you need to meet to qualify for the share exchange, they don't need to confirm those are met. They only have to confirm that tax avoidance is not a main purpose. So again, part of our job is making sure that there's absolutely no issue that the wider conditions are met, and therefore relief will be available from capital gains tax. The other one is when we apply for clearance, we would always also apply for what's called a transactions in securities clearance. And what that means is HMRC will confirm they'll not counteract this transaction by saying we think one of the main purposes was to obtain an income tax advantage, and therefore we're going to subject the whole value now to dividend tax rates, because obviously that would be disastrous. You'd be paying 40, if take my £10 million example, you'd be paying almost 40% in tax on day one because HMRC think you're trying to do this to avoid some income tax, which obviously in this case we're not. We're, again, HMRC are confirming that we're doing this for commercial reasons. There's no tax avoidance at stake. So that's quite a long-winded way of basically saying when we're doing these structures, we'll get an advanced clearance and we'll make sure as we go through the process that no tax exposure will apply on day one. So once we've got a holding company in place, obviously we then need to strip out those assets that we are trying to protect. There's a couple of ways of doing that, which I'll come on to the mechanics, but effectively we are transferring anything that we don't want in the trading company up to the holding company instead. And obviously Louise and Patrick will come on to this in more detail, but the main point of doing that is that normally you couldn't go up the chain of a group of companies in order to stake a claim on the cash, or in this case, the office building that now Holdco owns. So if there was a claim against the trade for whatever reason, it's only the assets that remain in TradeCo in most cases that should be liable. The other thing to say here is that we've moved cash into a holding company, but largely when we have a company, one company owning 100% of another, that means that it's a group of companies. It means for when we're doing intragroup transactions, 99% of the time those intragroup transactions are going to be tax neutral because it's all within this group structure. So as I said, I'd come on to the mechanisms for how we actually transfer these companies, these properties and cash and these assets up. There's two ways that we would typically do that. If we can, we'd do that via a dividend or a distribution in specie. And the reason for doing it that way is that that's by TradeCo, that's a voluntary contribution. So TradeCo is paying up we call it a dividend if it's cash. A distribution in specie is effectively a dividend, but using a non-cash asset. So a property, if you're transferring that via a dividend, that's actually a distribution in specie. The benefit of doing that is that there's no debt created when we do that, as long as it's enacted correctly, and there are some intricacies to make sure you do it correctly, but that's largely a legal issue. But if there's no mortgage on the property, for instance, then the asset is transferred up, and things like stamp duty, land tax, there would be no issues, because for stamp duty, land tax, it's payable on consideration. A dividend or a distribution specie has no consideration because it's a voluntary contribution, and therefore we don't need to claim any exemptions or reliefs. The main issue we have and why we can't always do what we call a hive up, the transfer of the assets this way, is that for company law purposes, you have to have sufficient reserves. And when I say reserves, I'm talking about the retained profits or the retained earnings that sit at the bottom of the balance sheet. The one positive about talking about the reserves is that you only have to have reserves of what the book value is. And when I say book value, I mean if you've got a property that's, let's say it's worth £5 million, but on the balance sheet, it's still sitting at £2 million at the original cost. You only need the reserves of 2 million, not the full value of the 5 million. So quite often we come across transferring assets up, even though they're worth a lot more than they're shown on the balance sheet. We're okay in terms of making sure we've got enough reserves, because we only need the book value for the purpose of the Companies Act. The other thing to say there, even if we have a property, so UK GAAP says when we've got investment properties, we should revalue them to fair value every year or so. If we revalue for accounting purposes, it means, use my example again, we'd have a £2 million original cost, and we'd have a revaluation reserve of 3 million. So in your accounts, you'll be sitting with investment property, £5 million. In the reserve section of your balance sheet, you'll have revaluation reserve, £3 million, and hopefully you'll have retained earnings of £2 million. So we can use, if we're transferring the property the revaluation reserve relates to, we can use that and treat it as realised for our purposes. So again, even if we have got a £5 million book value, it's not necessarily the retained earnings value. We can sometimes use the revaluation reserve as well. And as I say, if we can do it via distribution in specie, because that's a voluntary distribution, that kind of that's the date the transaction happens, and there's no further issues going forward. If we don't have reserves, what we'd normally look at is to do it via an intercompany loan. What that means is when we transfer it up to Holdco, technically Holdco obviously then owes, again we can use the book value, owes the book value back down to Tradeco. So there is still an asset on Tradeco's balance sheet, which is the debt that's now owed by Holdco. The issue we have then is we need to be quite careful in terms of when we write that off, if we write that off, and whether it's a commercial loan, because of course, if something is transferred and you say it's as a loan, but you never intend to repay it, then arguably it's never been a loan in the first place. So there's some tax issues we need to be careful of to make sure that we do this correctly, and there's no future tax issues, and also potentially some insolvency issues in the future if that's not done properly. So holding company structures, I've just kind of summarized some of the main benefits and drawbacks of these kinds of structures. Obviously, the main thing is the asset protection. So those assets we've transferred up to a holding company, hopefully there'll be no claim from any future liabilities against those assets that have been built up over the years. Largely, we can do this without any upfront tax costs, which is great. And obviously, we get HMRC clearance to confirm as well. Business property relief, if you qualified for that before, you should qualify for that after. So we should be unaffected there as well. It is possible for Holdco to now charge a rent. So if there's a property, they could charge a rent down to Tradeco if that's a desire. It does add some flexibility when we look to sell in the future. So it might be that, let's say that the shareholders don't need any cash when they sell, or it's really just their pension pot. So they could sell Tradeco, Holdco receives the proceeds of the sale, and because there's something called a substantial shareholdings exemption, Holdco may not even pay any tax when they sell the shares of Tradeco. So there's some flexibility there, and hence why I say there's the potential for a tax-free sale in the future. And we often also put these structures in place to incentivize employees. So you might want to protect those assets, but you might want to say to some of your key staff, we want to give you, let's say, 5% of the value of the trade going forward, as long as you meet certain targets. So splitting out the assets that you've built up so far could be a useful way of making sure that the employees don't share in those in that value. Some of the downsides of doing this, obviously there are some upfront costs, obtaining those clearances. Normally we would recommend using a solicitor to draft up those documents to make sure everything is above board. And as I say, with any due diligence in the future, if someone comes along to buy the company, it could cause a real headache if this isn't done properly. So we always recommend using a solicitor. Obviously, we've now got 2 companies, so we've got an ongoing compliance cost of actually filing accounts for those extra companies. And the other thing with an extra company is that the main rate now for corporation tax is 25%. The more companies you have that are connected and controlled, you reduce the thresholds at which you pay 25%. So if you had a single trading company before, 25%, but then if you insert a second company, your threshold is halved. So if you're over the threshold in TradeCo, then potentially you'll be paying that 25% quicker. It's also, depending on the size of the company, worthwhile checking that this isn't going to force you into having an audit when you didn't want one, because obviously ongoing costs in terms of having an audit is quite significant compared to having basic accounts drawn up by an accountant. So that's also something we would always consider before we put these kinds of structures in place. I only want to touch on demergers very, very quickly, just to show that there is an alternative to this, but there's also some further drawbacks as well. So what a demerger is, instead of inserting a holding company and having all your assets still within that group, what you could do is completely separate them out into 2 entirely separate groups. Again, there should be no upfront tax costs of doing that, as long as everything's identical as we had in the holding company structure, exact same shareholders, exact same proportions. We should be able to achieve that tax-free. The benefit of that, say for instance, you don't currently qualify for inheritance tax business property relief because you've got too many investment properties or non-trading assets. If we split out the non-trading assets entirely from the group, we could now end up with the TradeCo group on the left-hand side there, qualifying for business property relief, whilst PropCo continues not to. So we could actually use that as a mechanism to improve the tax efficiency for inheritance tax purposes. The downsides, this is quite a costly mechanism to put in place. There's quite a lot more work involved, both from a tax perspective and a legal perspective. And now if the office, in this case, is a trading asset that we're just trying to protect, we've now taken the office out of a trading group. So for PropCo, they're now renting the office to TradeCo. That's now an investment asset. So you're losing potentially some of those reliefs that I've already talked about, because you've converted a trading asset being the office. And even if the office was held by Holdco, it's still owned by a holding company of a trading group. So that's still fine. But in a demerger, that office is now an investment asset, and therefore we've potentially lost some relief. But the demerger does give us some benefits. I've already talked about the business property relief. If there's going to be a sale in the future, I've said if we sell out of Holdco in the first structure I talked about, just having Holdco own TradeCo, Holdco pays no tax, which is great because it's got substantial shareholdings exemption. But then the problem is, how do we get the cash out if we want the cash out? The only way to do that is either liquidate the company so it's a capital gain, or pay it out as a dividend. You might not want to liquidate it because you might have those properties in there, so there's extra tax costs to transfer the properties out on liquidation. But you might want some of those proceeds and therefore have to pay a dividend. And if we're talking up to 40% on dividend tax rates, that's obviously not very tax efficient. So if you think you might be looking at selling in, say, 3, 5, 10 years time, you might decide at this point, let's go the whole way. Let's do a demerger because we've got commercial reasons to do it. HMRC should give us clearance because we're doing this for commercial reasons now. But what it means is we're going to keep those properties. Those properties are our pension pot for the future. We'll keep TradeCo in a separate group. So if someone comes along to buy it at any point, even though we're not looking to sell in the short term, then the sale of TradeCo and retaining the properties personally will be subject to capital gains tax, potentially all at 10%. So there's a potential quite significant tax saving. Some of the work we do is what I call pre-transaction demergers. which is splitting these properties out of trading groups so that they can sell. And we always put sort of potential tax savings together to kind of justify why would we go to this effort before a sale, because a sale in itself is quite a significant transaction for most people. And normally, even on relatively small companies, if we're talking, say, I think the last one I did was, say, a £5 million company, the tax saving by demerging the property, which wasn't going to be sold first, was something in the region of about £300,000. So the tax efficiencies by demerging, if there's going to be a sale at any point in the future, could be quite significant. And it also means you don't have to do these transactions twice. You don't end up doing the holdco to protect your assets now, and then in a few years' time coming back and doing a demerger and paying even more cost. The other thing, if you have a demerger and you might be selling in the future, is that if you want to sell the property, you could sell the shares of the property company instead of the property itself. Again, the share sale will be a capital gain, which is better than income distributions. But also for the buyer, you might be in a good position to negotiate, because the buyer is buying shares of a company, it's not buying a property. So instead of the SDLT rates, which are anything up to 15%, the buyer is only paying 0.5% in stamp duty, which obviously then puts you in a better position to demand a higher price. So that's another benefit of doing a demerger as well. The final thing is, I've talked about EMI options, that's enterprise management incentives, which are a very tax efficient way to incentivize employees with share options. What you can't do in our holdco structure is issue those options in TradeCo whilst you've got a holding company in place, because one of the conditions for an EMI option is that it has to be issued by the top company. So if EMI options are going to be considered, then we need to look at doing a demerger so the trade is completely separate. So I just wanted to touch on that briefly, because that's something you might consider as an alternative if any of those issues do apply sort of in the short, medium or long term. But generally, when we're talking about just protecting assets, hopefully the holding company structure is much simpler to put in place and will give you that protection. And with that, I'll hand over to Louise and Patrick to talk you through kind of the insolvency and how this works from a legal side.
Thanks, Nick. Yeah, so hi everybody, I'm Louise Williams. I'm a licensed insolvency practitioner known as an IP, specialising in corporate restructuring, insolvent liquidations and also solvent liquidations. I've worked with a broad range of business sizes from startup to PLCs, undertaking all types of corporate and personal insolvency work. Currently work for Opus in the Nottingham office. There are 12 other offices, and prior to that I worked for a boutique firm and then spent most of my career at RSM through its various guises. He's slightly blurred out, but we will swap shortly. Patrick sat next to me. He's an ex-RSM partner, now consulting into the Opus Nottingham office. So you'll see from the slides that what we're covering, our aim is to help you understand the role and powers of an insolvency practitioner and how they would look at the structures described if the companies ever fell into insolvency. So just briefly, what is insolvency? Section 123 of the Insolvency Act 86 defines insolvency, but broadly it's an inability to pay its debts as and when they fall due. So there are two tests for this, a balance sheet and a cash flow basis. Patrick, in his speech shortly, will mention connected parties and associates, which broadly are directors, shareholders, relatives, employees, and debenture holders. So I'll just briefly explain the different types of insolvency events. So you'll hear something called a compulsory liquidation. This occurs when a winding up petition has been presented, an order made, and then a government official becomes the liquidator. There's a creditor's voluntary liquidation. It's seen as a burial procedure instigated by the directors. Members' voluntary liquidation, probably more familiar. It's a solvent procedure, good for utilising entrepreneurs' relief. A liquidator gets appointed in that scenario. Administration is seen as a rescue procedure and an administrator gets appointed. Receivership is where an IP is instructed by the secured creditor to realise an asset, usually property. And a company voluntary arrangement, or a CVA, is an agreement to pay creditors over a fixed period, and a supervisor is appointed to administer the arrangement. So in terms of the role of an insolvency practitioner or an IP, clearly the work falls into the following categories. Realise the assets, usually property, debts, cash, goodwill, etc. Review the company books and records to ascertain information to pursue claims against third parties. report to the government on the fitness of the directors within 3 months. It's a factual yes/no questionnaire. And then to distribute the funds realised after costs to creditors in order of priority. I'm just going to hand over to Patrick now to talk about special legal action that an insolvency practitioner can bring and the various antecedent transactions.
Super. I mean, I suppose the reason that most people will be looking at these structures is they're looking at, if bad things happen to the trade, how do the shareholders put themselves in the best possible position so that the good assets are not available to be sold and realised for the benefit of creditors. They're separate. So you kind of everyone's where the concept of group accounts, group structures. And quite often people think about, there's a group of companies. But if a company goes into insolvency, we only look at the individual legal entities. So the insolvency practitioner can only has power over the assets that are in a particular legal entity. So in this example, if we've done the restructure and then in 3 years' time, let's say the trading company has problems and goes into insolvency, the liquidator is only appointed over the company that has the problems, i.e. the trade company in this case. And if the other companies are solvent and there's no cross guarantees or anything like that, then the assets in those companies are not available for the insolvency practitioner to sell. So although it's a group, he's only appointed over one of the companies. So what happens then? What powers does the insolvency practitioner have to try and unpick transactions that have been entered into prior to the insolvency? And the 1986 Act, which is the act that seems like quite a long time ago now, but still governs insolvencies, set out various powers that an insolvency practitioner can have to try and look at transactions. So the first one now, I've got it, section 238 of the Insolvency Act, is transactions at undervalue. So what that's trying to do is trying to stop directors disposing of assets at something less than market value prior to an insolvency. And an insolvency practitioner can apply to court to have these transactions basically get overturned, but only within certain parameters. So firstly, the transaction would have to have happened within 2 years prior to the insolvency. So if your scheme happened, if that happened 3 years before, then this particular section wouldn't apply. One of the defences is if you can show that the company was solvent at the time. So even if there's been a transaction at an undervalue, there was a sale of, let's say the property was transferred at a price, let's say it was transferred at a book value price, which was less than the market value price. If the company was solvent both before and after the transaction, then that would be a defence. So it's quite, Section 238 is quite limited because it's limited in time and it's limited by the issue of were you insolvent at the time. The next thing that the insolvency practitioner can look at is something called preferences. So it's saying in the run-up to an insolvency, have you chosen to prefer one creditor over another? And typically one of its main aims is trying to look at connected parties. Have connected parties preferred themselves? So as part of any transaction, if the deal was that an asset was transferred and that eliminated an already existing intercompany loan, i.e. effectively the intercompany loan was repaid by the transfer of an asset, then the insolvency practitioner have a go at that. And again, if that happened within 2 years, and he doesn't need to prefer, he doesn't need to show that you had the desire to prefer. It's just a matter of fact between connected parties. If that happens, he can have a go at that. So they're quite limited areas, aren't they? They're sort of, well, it's limited by time, and then you've got the defence of solvency. And this is where we come on to section 423, which is a different beast altogether. That doesn't really have any limits on time, but what it does has is you have to be able to show the intention on this one. So it's a bit like you have to get inside the mind, the corporate mind of the organisation who's put in place these structures. And it's looking at transactions at undervalue. Were they there to put assets beyond the reach of creditors? So broadly speaking, if the asset is transferred at value, and that is market value, then this won't apply, because if what you've ended up with, instead of having the company's lost its property, but has it had an asset in return for the same value, then that's fine. That would be a defence. So ideally, if the asset was transferred and you got cash for it, it's like sold in a conventional way to another group company, that would be fine. If it was sold and it was left on the intercompany, then you've just got to look and say, well, was that, what's the value of that intercompany asset? Is the company losing the property actually getting an asset in return that's of equivalent value? So that's but of course, what you have to do is show, what the insolvent practitioner has to show is intention there. So that's quite important. The other two don't require intention, but 423, there's no time limit, but you have to show intention. So with these claims, you can imagine if the company is underperforming and everyone panics and say, we need to put a structure in place to get this right, you're going to be more at risk. Whereas if the business is very solvent and you put them in place for some future problem, you'll be fairly bomb-proof on that. And I think it's the phrase that George Osborne used about when he said, we are repairing the roof when it's shining. So if you are putting these transactions in place when there is no real worry about solvency, you're in a lot better position than if you try and do one of these transactions with 3 months to go to insolvency. Then it becomes harder because you've clearly some of the intentions are going to be quite obvious. So those are the primary claims that an insolvency practitioner can make. He also has powers around what's called misfeasance, which is about directors acting in using having fiduciary duties and acting in the best interest of the company. So what we're going to do now, Louise is just going to go through some practical steps that we think you need to put in place if you're doing one of these transactions, so that in the event that it does go into insolvency, you're better protected.
Absolutely, that's right. So Patrick will come back to a conclusion in a moment, but in terms of practical steps, transactions involving the transfer of assets need written valuations and proper terms of reference. So that's really important, and that comes back to what Patrick was saying about having sort of the evidence there. Where a transaction involves dividend, careful checks should be taken around the availability of distributable reserves, which is standard, obviously, in the normal case of paying dividends anyway. Where possible, use a sale and purchase agreement to show the assets and the values being transferred so that you've got some sort of evidence there. And equally, any decisions that are made, we always say it was helpful if you minute and explain all of your actions. Certainly then you're able to provide that if somebody starts to challenge or question anything that you've done. In terms of the suite of the documents, these need to be prepared with a view to them being read later by a critical IP. So if the worst happened and an insolvency practitioner is appointed, just be mindful when you're preparing them what they're looking for, which is obviously what Patrick's sort of just touched on previously. When a property is transferred at market value, but the consideration is an intercompany loan, then careful consideration should be given to the actual effect value of that loan. Think about, can it be repaid? What assets need to be realised to repay that loan? And who are the other creditors in the company? I think you need to state the reasons for the transactions and just be careful about those reasons. Avoid using a cross guarantee, as this can have the effect of drawing a solvent company into the problems of an insolvent company. So just give that some thought. And then also the same applies with a group VAT registration for all the companies. That can slightly complicate matters. So give that some consideration also. We just wanted to mention that historically, from experience, we'd say that insolvency practitioners taking action usually relied upon us obviously having a good case, but also having the funds in the case to be able to take any action against company directors, etc. But what we have seen in recent years is a large increase in organisations offering funding IPs to take the legal action. So as I said before, we were always a bit nervous. We didn't have the costs in the case and we couldn't provide security for costs if the case was lost. Whereas now AT insurance is available so that insurers will pay the adverse costs of if the IP loses. You might well have heard of funders such as Manolay who are looking to buy these legal claims and pursue them through the courts. So I think it's probably fair to say that there's more of an appetite to pursue claims, depending on the merit of them, of course. But I think that, as a director, just be mindful that these things don't get buried, perhaps like they might have previously done, depending on funds in the case. So Patrick's just going to conclude kind of what we've talked and how that links in with what Nick's prepared.
Yeah, so we've seen quite a lot of cases where, so we've been appointed as liquidators or administrators where at some point in history there's been a holdco has been put in and a property has been moved out. And in essence, I suppose the key elements to it are, for defence, is were you solvent at the time? That's a big defence. Did it happen 2 years, beyond 2 years, working backwards from the liquidation? If you're over 2 years, you've got a lot of defences. And the big one is, as long as you are transferring stuff at market value and you evidence that it's market value, then it's very hard for insolvency practitioner to bring a claim, because the company hasn't, the transactions that took place didn't actually harm the company that eventually went into liquidation. Yes, it did have an asset, but that's either been replaced by another asset or it's been distributed and under with distributor reserves, and that was properly done at the time. So I would always say each case is different, and in doing any of these things, I think the lawyers that you use are very important. So one, just in terms of how the documentation, but also the lawyers to say, right, what might be the challenges in your particular case, because obviously every case is different. And then it's if you've hit the main points about solvency, about market value, it's very hard to bring a challenge. If you try and do these too late, when the company is having problems and solvency is an issue, and the solvency is fairly near, then it's harder. So I think it's a thing to put in place while the going is good, but you'll just have that general worry about what if in the future. So yeah, there are our points. Thank you very much.
Thanks both. That was really interesting. Yeah, I think those couple of points I just think are absolutely vital. The things I was writing down as I was learning everything as well. If we can selling for market value and then putting the transaction in place whilst we're solvent, because obviously a lot of the time these are the types of things people don't think about until it's too late. And as soon as it's too late, then once we do this, then there's almost no point in doing it. So and it's interesting as well, as you were talking about the distributable reserves, when we see the legal documents that solicitors prepare putting structures like this in place, there's quite a significant section in the board minutes talking about the reserves, and it's always a case of how do we justify the reserves. Normally we'll look at the accounts that have most recently been filed, but normally there's quite a gap between the last set of accounts at company's house and the time we're actually doing this transaction. So we'll often at least try and have some management accounts to have a bit more recent. So it's a lot more clear that we've got plenty of reserves to do it, and then hopefully that will give some protections to the shareholders and the company as we intend. So no, that was really interesting. Thank you. I know Sasha's got a few questions come in as well. I don't, if anyone also wants to raise a hand and use video or speak, then please feel free to do so. Or obviously any more questions in the Q&A box, and we'll take those now.
Hi, Nick, I have a question for you. So if I've already have a holding company with its own business, can I incorporate a new subsidiary to move the assets across rather than into the holding company?
Yes, you can. So from a tax and legal perspective in enacting that, that's perfectly plausible. So I've talked quite a bit about distributable reserves and doing it as a distribution in specie where possible. We have done transactions in the past where we've done what's called a sideways distribution. So you can't, generally most people, or I think what the Companies Act largely says is a distribution is a distribution to a company shareholders. So if you've got a holding company owning a trading company, and the trading company wants to transfer assets, if it's going to be a distribution, it has to be to the holding company. But I know certainly a number of lawyers who also think from a legal perspective it's possible to do a distribution from a subsidiary to another subsidiary. So yeah, it's entirely possible to do from a tax and legal perspective. I don't know if Louise and Patrick have a view on how well that would work from an asset protection structure. Can we go sideways to the other subsidiary?
I don't understand how you go sideways. I don't I don't see what I don't understand that.
Right. So I think what you said earlier, when in sort of earlier on, was you would only look at the company in question. So if we've got a group where we've got a holding company, owning two subsidiaries, presumably you can only look at that one company that's insolvent if we've still got a successful company on as another subsidiary.
Yeah, so if it's like a sister company, it's sort of it's beneath the holding company, like ours is beneath the holding company. No, we can't have any of those assets.
Right.
We might be able to look at claims involving transactions between those two companies. So yes, we couldn't look at that. I just don't understand how you get from an asset sideways unless it goes up and down.
Yeah, and I think the jury's out really, because I know solicitors who say you can't do that. You can only go if you're going to, as I said, typically a distribution is a distribution in relation to the shares, and the holding company owns the shares.
Yeah.
So how do you move it? And yeah, it does seem a bit odd. I know a number of solicitors who say technically it's possible under the Companies Act, but this is a company law question, and I'm not going to try and explain it or understand it. If a solicitor says it's possible, then the tax consequences are actually the same either way. If we're talking about a group where you've got holding company owning 100% of two subs, then the tax consequences are the same because we're all within a group, and therefore we get group relief if there's a capital gain, and we get SDLT relief. Or if it's a distribution in specie, then we don't even need the relief. So, yeah, from a tax angle, I've not got a problem with it. And if a solicitor says it's legally possible, I'll let them.
Yeah.
I'll let them do it. But yes, I do take your point that it seems a bit strange to be able to do it unless you did it as an intercompany loan. But that's,
yeah, I can see that if you're selling the assets between sister companies and loan, I can see that, but not
the distribution.
Not the distribution. Yeah.
Agreed. Yeah. Okay. Hopefully that answers that question. Have we got any others?
Great, thank you. Yes, leading on to my next question. If we do a demerger, how do we get the extra cash from the training business to the other group, and are there any tax implications?
Yeah, so in our subsidiary holdco structure, as long as you've got reserves and let's say you want to invest more into property or just hold the excess cash in the holding company, you can just dividend the cash up, which is nice and straightforward. The holding company doesn't pay tax on the dividend it receives because subject to some very minor conditions, UK companies don't pay tax on receipt of dividends. So that's not a problem. The issue is when we are then trying to move it to another company, again, we're coming back to, you can only do a distribution to the company's shareholders. So a subsidiary can only go up to the holdco, or possibly, depending on which lawyer you talk to, maybe to a company within the group. You certainly can't do a distribution from one company within a group to an entirely different group, because they don't own the two groups, although they're connected by having common individual shareholders at the top, they are not within a group for capital gains tax purposes and those kinds of things. So how do you get it across? Most of the time people will lend the money across. That's not very helpful. Again, coming back to if we're doing this for asset protection purposes, we always put a caveat in. If you're going to lend money across to a company, it has to be commercial, because, and I've not actually seen HMRC argue this point, but there is a theoretical problem that if you lend money to a connected company outside of the group and then write the loan off, which if you're trying to do this for asset protection, you're probably going to want to write it off as soon as you can. There is a theoretical argument that HMRC can say the only way you can do that is take the cash, pay it to the individual shareholders, then the individual shareholders put it back in. Even if you just move the money from one bank to the other company bank account, in theory, the only way to do it from a tax perspective is to follow it through, go to dividend it out to the shareholder, and then let the shareholder lends it back into, let's say, the property company. Which obviously doesn't work because then you're paying 40% or up to 40% in dividend tax rates. So it's possible to write off commercial loans, and I think there is, as I say, that's a theoretical argument. I've not seen HMRC take it in the past, and if it's an entirely commercial loan, and that means when you actually make the loan to invest in the other group company, you have to intend to repay it, then you could, in theory, write it off without that tax implication, subject to the commerciality of that transaction at that point as well. So once you've demerged, it is a lot more difficult effectively to get the cash out of that company, and without the risk, at least, of potentially incurring income tax on that. Any more?
Great, thank you. Yeah, I have one final question. So if we have two groups of shareholders in our business, the family members who have run the business since incorporation and some high-level management, can we insert a holding company which is owned by just the family members and leave the management as shareholders of the existing company?
Yes, you can, but not without tax implications. So I talked about the conditions for actually setting these structures up. To insert a holding company, if you're doing 100%, and as I said before, if you mirror image everything, all the proportions are identical, the shareholders before and after are the same people, and they own the same proportions of shares in the same classes, then there's no stamp duty. But if you don't have that mirror image, let's say you've got, I don't know, 10% of your shares are management shares and the other 90% are family shares, then the stamp duty relief is not going to be available. The good thing is that stamp duty and I'm talking about I'm talking about stamp duty, and not to be confused with stamp duty land tax. It is only at 0.5%, so that might be a cost you're willing to incur to ensure that the management team stay behind in the trading company, because it's only 0.5% of the value. But again, what Louise and Patrick were saying, when we do these things, we need to make sure we've documented valuations and things, and it would be even more important here because we would have a stamp duty charge, so that we'd need to be aware of that in terms of adding the extra cost. In terms of whether you can do it for capital gains tax purposes, again, it shouldn't be a problem. The main issue on the share exchange rules that I was talking about is the holding company has to acquire more than 25%. So as long as your management team don't account for 75% or more, then the shareholders who are swapping shares up to holdco would get relief from capital gains tax. So it's possible, but the stamp duty is your main problem.
Great, thank you, Nick, Louise, and Patrick. As mentioned, this has been recorded and we'll share it after, this afternoon, hopefully. And if you have any additional questions or more information for the speakers, their contact details are on the final slides. Great, thank you, everyone.
Thanks a lot.
Thank you. Bye-bye.
Bye.
Bye.